So we have about an hour and 15 minutes for me to go through the basics of the ESOP idea for successful private companies. Before we start that, let's take a look at the material. Each of you should have some material I gave you or coming in, it was on the desk. If you open up this tricolor folder, there, on the left-hand side, there are two metallic blue brochures. ESOP Pros and Cons and ESOP and Employee Productivity. These are the two best publications our firm produces on the ESOP topic. So if there's somebody from your firm who's not able to join you today, these would be two good items to show them. The first one, probably the most important, is this ESOP Pros and Cons. And what we've done is we've taken the concept of ESOP and developed what we think is an objective and comprehensive way of looking at the idea. And we haven't pulled punches. There are some potential downsides of the ESOP idea. In fact, if you turn on pages 12 through 14 of this booklet, 12 through 14, we talk about some of the 9 possible downsides of ESOP. And I have a section, I can't spend a lot of time on that today, but I've got a section that we'll talk about the potential downsides of an ESOP. But this brochure, Pros and Cons, does give you some examples of techniques, concrete techniques clients of ours have used in using ESOP as a financial tool as a succession plan for successful private companies. Now the next brochure is this Pros and Cons of Employee Productivity. And this gives you a sample of some of the techniques clients of ours have used to really communicate to the employees what this idea is. Basically, ESOP is a 401k plan or profit sharing plan that buys your company stock, not somebody else's stocks or bonds. And this allows shareholders of your company to become more liquid and diversified by selling part or all of their stock into the ESOP. So it's a cash out tool, but it's also, from the employee's perspective, an employee benefit plan where the employees can become part owners of their own company. And some of our clients say, well, that's not really why the ESOP idea is attractive. What really is attractive about ESOP is it's a way that one of our shareholders or two of our shareholders can cash out of part or all of their equity as a succession plan for them, as a shareholder liquidity plan for the shareholders. A growing number of our clients say that part of the importance of ESOP is also we'd like to have the employees be able to build into an equity stake in the company, earn into an equity stake over time. There's a whole host of other items on the left-hand side. I'm not going to talk about each one of them, but let me just do a couple real quickly. The first is this 22 ESOP myths and misperceptions. This is on the left-hand side of the packet, buried behind those two blue brochures. And this ESOP myths and misconceptions does list out about 22 different aspects of ESOP that are just fictitious. A lot of half-truths out there about the ESOP ideas, so we've tried to dispel that. Articles about how to sell to an ESOP giving better financial returns, ESOP for S&C corporations. Now there's a confidential ESOP feasibility questionnaire, and if you're an operating company and if you'd like to take a look at the ESOP idea, a good starting point would be the 2-page questionnaire. And I'm happy to sign a confidentiality agreement with you or a non-disclosure agreement, but then the data on this 2-page form allows me to zero in on your firm financially, your earnings, your cash flows, and your balance sheet, and then also looking at the objectives that you have to see if the ESOP idea might be a good match for your given objectives and timetable. Now the next item is a blue horizontal, it's a landscape exhibit, and this is a sample certificate that employees receive. And you can see that there are 2 different ESOP accounts in this landscape blue brochure. There's the one right there in front of you. Yeah, good, got it. And the top is the company stock account, which is where the employees earn into equity shares of the company. Then there's the other investment account, or the OIA as we call it. And the vast bulk of the plan is a company stock account. So the ESOP is a retirement plan that primarily buys stock of your company. Every other retirement plan, pension, profit sharing, 401k, those plans primarily buy diversified assets. So ESOP is a pension plan that primarily buys stock of your company, and this allows shareholders of yours, any shareholders that would like to sell some of their stock or all of their stock, they can sell into the ESOP, whereas you really can't sell private company stock into a profit sharing plan or a 401k plan. And then because the ESOP is primarily buying company stock, employees of the company become part owners of their own company, whereas in a profit sharing plan or a 401k plan, they become part owners of a CD or a T-bill or S&P index. Okay. I think we can dispense with the rest of this, except there's a couple of good reference articles reference items, we have about 120 of our clients are shown on the reference list. And we've broken our clients out geographically. So here in Louisiana, in this east and southern section of the U.S., we've listed, of course, the company name, in italics, the company primary business, whether they're an S or C corporation, name of the company, address, and contact name. So if you're an operating company that would like to take a look at the ESOP idea, we recommend you contact 2 or 3 or 15 of these companies, and they are very, very vocal about their ESOP. The very first name on the reference list is a client of ours in Lafayette, Louisiana, called AGI Industries. They distribute valves and other controls, and they also build systems, valve systems typically for the refineries. And that'd be an excellent reference on the ESOP topic in our company. And then there's a Tombstone. I'm one of 6 partners across the country who install ESOPs, and last year we installed about 45 across the U.S. Here's a list of those as well. Okay. Then the 2 pocket brochures, we have Minking Associates, which is our consulting firm. There are 40 of us that advise companies on ESOP, help the company owners understand what ESOP is, how it possibly can work. We can then be engaged to implement the plan, certainly. And there's a group called Sansom Street. The Sansom Street is a catalog of about 15 independent contractors. If you do an ESOP, the ESOP again is primarily buying stock of your company. And our clients are not publicly traded, so there is no stock market for the firm. So the way that we have the ESOP make sure it's not overpaying for the stock is we have an independent third-party appraiser that is once a year coming in to appraise the company. And it's typically looking at the company's earnings and cash flows, and some multiple, price earnings multiple on earnings or cash flow is the primary way to appraise a company for ESOP purpose. Okay, in fact, there's a sample here. This is probably a pretty good handout. This opinion of value, it's also deep in the pack of materials there. And this sample appraisal, opinion of value, if you pull this, turn to page 42 in the booklet, right in the middle of the page, there are 5 valuation methods that were used by this particular appraiser. And of the 5 methodologies, 4 were included in the overall analysis. The 5th one, which happens to be listed number 1, adjusted net worth, was deemed to have no relevance in assessing the value of this particular company. That's because most successful privately held companies are valued based upon some multiple of earnings and cash flow, not book value. So you can see items 2 through 5, capitalization of earnings, capitalization of dividend capacity, discounted future earnings, and discounted cash flow. So these are the 4 methods used by the appraiser. Okay, so anyway, you might want to pack away that material, but you might want to hold out the certificate if you'd like. We'll talk about that briefly during the course of the day. How about during the course of the next hour? Jerry, can we make this a day-long seminar?
Absolutely.
That's what I'm used to, so let's not do that for sure. Okay.
There's a tornado going outside.
I heard about that. I heard about that. Watch out for the lights, though. Okay. So each of you have a book, and I've reproduced in the book each slide. So if you'd like to track the point step by step there, it should be pretty user-friendly. So we're here today to talk about the ESOP idea, but the ESOP idea, if you turn to the next slide, it's really the ESOP. There are 2 different items. There's a plan, ESOP with a P, and there's ESOP Trust with a T. So let's just say we have 100 employees in our company. And if you do an ESOP, you can exclude employees that have been there less than 12 months. You can also exclude employees that work less than 1,000 hours per year. So let's just say of our 100 employees that we have in the rank and file, 20 are part-time and or short-term. So we have 80 employees that are in the plan. So what we do is by doing an ESOP, we don't create 80 new shareholders. Say there are 10 of us, each owning 10%. We have this private company, we're putting an ESOP in. By doing an ESOP, we do not create 80 new shareholders. We create 1 new shareholder called the ESOP Trust. So right off the top, the employees are not direct minority shareholders, they're beneficiaries of a trust. Now the trust owns the stock. Now the trust has a trustee like any trust, and the trustee of the ESOP Trust typically is the board of directors, or a subset of the board of directors. So it's the board of directors named trustee who has all the power in the ESOP. They're the ones that vote the ESOP stock on behalf of the employees. So the employees are earning into an equity stake of voting common stock, but the voting common stock is voted not by the 80 rank and file employees. The voting ESOP stock is voted by a trustee named by your board of directors. Now the plan is the inch-thick document that describes in great detail how the ESOP operates. So when new employees join the company, over what time period do they become part owners? So what's the probation period for new employees? How do we divide the stock among the employees? Basically, we divide it based upon compensation. But all the rules of how the ESOP works mechanically are really spelled out in detail in the plan document. So the ESOP trust is the direct owner of the stock, not the employees. The employees are beneficial owners. So the employees have a chance to become a part owner of their own company. So the incentive is quite real, and that is if the employees can help the company become more profitable through revenue and or cost enhancements, that helps raise the share price when the employees leave the company years later for whatever reason, death, disability, retirement, quitting, being let go. When they leave the company, they'll sell their ESOP stock back at the then current fair market value. So if the employees can help the company become more profitable while they're at the firm, they're benefiting themselves economically. Voting is handled by the trustee named by the board, but economically the employees have a stake in the company's success financially. Required information, because the employees are beneficiaries, not direct shareholders, the required information is limited to what they have on that account balance. So what's the three perspectives on ESOP? What's ESOP mean for the business owner? What's ESOP mean for the employees? What's ESOP mean for the corporations doing the ESOP? So to the business owner, the ESOP is a buyer of company stock that provides tax advantage, liquidity, and diversification to shareholders. So tax advantage, liquidity, diversification. So if I own stock of a private company, we have an ESOP. I sell my stock to the ESOP. First of all, I get fair market value because we have this independent arm's length appraisal done that establishes what the fair market value is. So I, as a seller, get the benefit of fair market. The ESOP, the buyer, pays no more than fair market. So we have a happy kind of middle ground. So I get fair value, and then as a selling shareholder, I get tax advantage liquidity. And so either I pay cap gain tax at the time of my sale, or I can defer capital gain tax. Now, if I defer capital gain tax, I have all my money to reinvest. Whereas if I have to pay capital gain tax, let's just say that your effective capital gain tax rate is 25% with federal and state and the Medicare 3.8% surtax. Sell a dollar of stock and you only have 75 cents on the dollar to reinvest after tax. So I either pay the 25% tax, or in some ways I can defer that capital gain tax, which means I've got 100% of my money to reinvest, not just 75 cents on the dollar. And we'll talk about that tax deferral. Okay, so I think there's a lot of liquidity and diversification here, tax advantage. Now the other idea here is flexibility. Say there are 10 of us each owning 10%. We do an ESOP. We get the company appraised. We then turn each, the 10 of us, and say the share price today is 40 bucks, 10 cents a share. Does anybody want to sell part or all of your stock? So we go around the table, and maybe half of the shareholders say, thanks, no thanks, we don't want to sell today. Maybe later, but not today. But maybe of the other half that want to sell, maybe one or two want to sell their entire interest, and one or two may want to sell just a partial interest. So it's flexible. No shareholder is forced to sell in an ESOP. All right, to the employees, the ESOP is a company-funded retirement plan that encourages employees to think and act like owners for the benefit of the owners and the direct employees. So because their pension plan, called ESOP, is primarily buying stock of their own company, they become part owners of their own company, and as a result, it's in their interest economically to help the company perform better financially. Because after all, when the employees leave your firm years later, they'll sell their ESOP stock back at the then current fair market value. If they've helped the company economically while they've been at the firm, then they can reap the benefit of that at the back end. To the companies, and by the way, to do an ESOP, you need to be a corporation, either an S corporation or a C corporation. How many operating companies do we have in the room today? And are you advisors, or what your capacities as business owners, or just consultants, or so C corporation or S corporation? S corporation. Yeah, so you need to be a regular corporation or an S corporation. It turns out a little over half of all new ESOPs are done in S corps versus regular C corporations. Okay, it's a pre-tax financing plan that can help perpetuate the company as an independent company. So this is part of this whole, the CLITA, I think, idea is if there's a successful private company that would like to cash out some shareholders but still keep the company locally owned to preserve the local jobs. That's the ESOP concept. And there are two of my clients right here in the neighborhood. One is AFCO Industries. I put an ESOP into AFCO Industries back in 1994, I guess it was. And Wayne, you were, I guess, banker for Hibernia Bank at the time. And you were part of the financings for, because they did 3 or 4 successive blocks.
Start off with a small percentage, probably around 10%, I remember.
Yes.
And like 94, that's when we started. I thought it was a little bit earlier than that, but.
It could have been earlier, yeah.
They made it along this time and really test the water and see how it impacted the company.
If it really worked.
Yeah, it worked.
And as long as it wouldn't be too much pressure on the company financially. And so instead of them selling all the stock at the front end, which would have been tremendous potential pressure on the company financially, they did it in stages. And so were you there for 2 of the 4 stages, or how many of the stages were you? All of them. Terrific. Now the other company, I think you said on the way in this morning, and I just met Wayne coming in this morning or this afternoon, but you said that if they hadn't had the ESOP in place, that company probably would have been sold to some third party.
Yeah.
As a way to cash out the 4 original shareholders.
Likely, the 4 owners, the 10 owners getting closer to retirement and thinking about it.
Yes.
For the next strategy. And I will say that what made it so easy to do was your underwriting. Basically, we just, each time we had a package to go in and do another section.
Yes.
ESOP, that was part of the underwriting package that gave credibility, and it worked.
Worked nicely. And so it preserved those jobs and probably grew the jobs locally. And hard to say what would happen had there been no ESOP, but the odds would have been higher. The company would have ultimately been sold to some third party who may well have moved some or all the jobs out of the area. Now the other client I have here in town is Meyer LaCroix Hickson, engineering consulting firm with about 40 employees. They do a lot of civil engineering and surveying work. Robert Hughes is the main shareholder there. So we put ESOP in there 2 years ago. Again, as a way to provide liquidity diversification for the shareholders, provide the engineering firm employees chance to become part owners, and also pre-tax financing for the engineering company. Okay, so ESOPs have been around. Since 1974. Over 21,000 ESOP companies established. Today, there are more ESOP participants in the private sector than there are private sector union members. That's the first time that happened in the last. Forever at that point, about 13,000 employees. So about 35% of all ESOPs are cases where the ESOP owns over half of all the stock. But that's still a minority. So 65% of ESOPs own up to 50%. The median size of our client in terms of what percent of the company is owned by the ESOP, it's about 45%. And so these are substantial ESOPs. They're not 100% transactions, but they're certainly not 1 or 2 or 3% total transactions. Why are ESOPs popular, the big 6? Well, if the selling shareholders do not have to pay capital gain tax on the sale of their stock, this is true if you're a regular C corporation, not a sub-S corporation. If you can defer capital gain tax on the sale of your stock, then you've got all your money to reinvest, not just 75 cents on the dollar. Pay little or no income tax. This is true for CRS corporations. Every nickel of what the company contributes is deductible to the corporation, so a lot of our clients will use the ESOP to eliminate or at least substantially reduce taxable income, control the company as you do now. Now the ESOP can buy stock on a very small scale, year by year, just 2, 3, 4% a year, or it can buy a block of stock like AFCO Industries did over the years. If you're doing it, about half our clients leverage it with either bank financing or seller financing. The other half will keep ESOP owning stock year by year gradually. But if you do a leverage transaction with bank debt or seller financing, then the company can, of course, deduct the interest. You don't need to have an ESOP to have the interest be deductible to a corporation. But unique to ESOP is the fact that the company can use deductible pre-tax dollars to pay back the principal on the loan. It's the only place in the tax code where a corporation can use deductible pre-tax dollars to pay back the loan. So it's a much less onerous buyout mechanism than a traditional after-tax buyout mechanism. ESOP share of S earnings is exempt from tax. Now, this is an important point for the S corporation ESOPs. Say we have an ESOP in place. say we have no ESOP in place. We have, there are 10 of us each owning 10%, and we're an S corporation. We make $1 million in a given year. Well, what happens is each of us get a K1 if we each own 10%, we get a K1 for 10% of the earnings. We pay tax individually on 10% of the earnings. So every dollar of S corporation earnings is taxed once at the shareholder level. Now, if I sell my stock to an ESOP, and the 9 of you hold your own 10%, next year we make $1 million. Everybody gets a K1 for 10% of $1 million or 100 grand. Now the company's probably going to distribute 40% of earnings in cash, so we have cash to pay our income taxes. You've got to use your 40% to pay your taxes. The ESOP though, the ESOP gets 40% of 100 grand, $40,000 in cash proceeds for S distributions, but the ESOP does not have to pay tax on its share of S earnings. So the ESOP does not have to pay tax on its share of S earnings. So the $40,000 that you get, you have to use to pay tax, and vice versa. Everybody has to use their $40,000 to pay tax. But the ESOP, because it's not a taxpayer, the ESOP gets the $40,000 and can use the 40 grand to buy more stock. Okay, employees become more productive. I think it's potentially become more productive. Nothing automatic happens about that. Big enough for an ESOP. Typically, a firm ought to have at least a dozen full-time employees that have been there at least 2 years. Right industry. A myth is you have to have 500 employees or 250 employees, and that really is a myth. Meyer, LaCroix Hickson has about 40 employees, and I think typically a dozen, 12 to 15 full-time employees is probably the starting point for ESOP. Right industry, there is no wrong industry. So we have a lot of architect engineering clients. We've also got AFCO Industries, traditional manufacturing concerns. We've got a lot of distributors as clients. Ready for an ESOP, your firm ought to have at least 5 years of track record because there's risks of doing an ESOP for the employees, and you want to make sure the company's on solid footing when the ESOP is established. Okay, so there are 4 uses of an ESOP for successful private companies. And we'll talk at some length about the first of the 4, which is liquidity diversification for the selling shareholder. So is there an exit strategy for the business? It may be that we're all in our 40s and none of us is really worried about this, but as John says, it's never too soon to start thinking about succession planning. So at some point, shareholders will probably want to get liquidity, either before retirement or after retirement, or during retirement. So the question becomes, do the current shareholders want to retain control? And if versus achieving liquidity by selling out to some national company or some bigger firm. And I'm not here to badmouth selling out to another firm, but if you choose to provide liquidity for shareholders but retain control of the corporation locally, then the ESOP is a very viable technique in many cases. So here's a quick snapshot of a shareholder's personal financial net worth. So this is not the real estate owned by the individual, but the personal financial net worth of our shareholders of successful private companies. And for many shareholders, the bulk of their financial net worth is private company stock. Now that's may have been a good investment over the years, but every financial planner you talk to will say that it's important to diversify, to become more liquid and diversified. So this individual sold 2/3 of their equity interest in the company and redeployed the money into fixed diversified assets, Warren Buffett type of securities, fixed income, corporates. Don't forget about the cash position to beef it up and add that vacation house. So this shows the flexibility to the shareholder of being able to sell part of his or her interest. Now some of our clients will sell their entire interest, but a lot will sell just partially. And that's what AFCO did in those 4 successive sales, 25% per each time to the AFCO ESOP. Okay, so the ESOP creates a market for shareholder stock. Owners can cash out a part or all of their, or none of their stock. We get that stock appraisal done once a year. We turn to all the shareholders. Does anybody want to sell any of your shares today at the current share price? You could do it all at once, or you could do it over a multi-year period. No required change of control, no third-party participation, no disclosure of confidential information to competitors. And we say lower transaction costs. Now, it's a lot more expensive to do an ESOP than, say, 401k plan, but it's also so it's more expensive than 401k, but it's a lot less expensive than, say, selling to a third party. Okay, so I'll use these numbers to kind of illustrate some of the key points of how the ESOP can work financially. So we have annual revenues of 15 million, and nothing magic about 15 million. Many of our clients have over 15, many have less than 15 million. We have total eligible payroll of $4 million. So let's just say, remember we had 100 employees in our company, but let's just say 20 are part-time or short-term. So we only have 80 employees that are eligible to be in the plan. The eligible payroll includes 80 employees. Now let's just say that the average W-2 compensation for the 80 eligible employees is $50,000. So we have $50,000 times 80, we have $4 million of payroll. Now why is this important if we do an ESOP to have enough payroll to make the system worthwhile? The whole system works on the company making a contribution to the plan, deductible to the corporation. ESOP takes the cash to buy stock from shareholders. There are limitations as to how much can be deducted and contributed. And that number basically is 25% of payroll. Take the total payroll, annual payroll for all eligible employees, 4 million. 25%, or in this case $1 million, is the maximum deductible company contribution per year. So we have adjusted pre-tax profits of $2 million. Now, a lot of our clients say we're not showing, when we go to the bank, we're not showing that we're making $2 million pre-tax, but there's some adjustments. Maybe your earnings are half of that, but there's some one-time expenses that would be added back, or some discretionary expenses that would be discontinued. So we have adjusted pre-tax of $2 million. Now, this company has 2 shareholders. If either or both would like to sell some of their stock or all of it, they'd be receiving the quote-unquote fair market value of 10 million. So 10 million in this example is take our adjusted pre-tax of 2 million times a multiple of 5, a PE multiple of 5. So simplistically, the company trades for 5 times adjusted pre-tax earnings for $10 million. Now the book value we assume is meaningless. In fact, on page 42 of that valuation, it showed that the appraiser placed no emphasis whatsoever on the net book value approach. Any questions on the setup here? So I'd like to cash out very gradually. How does the ESOP work? Well, we can start off with a 6% sale. The company, this is the S or C corporation that adopts the ESOP. The company contributes $600,000 into the ESOP. This is deductible to the corporation, because remember the maximum deductible contribution in a given year is 25% of payroll, or $1 million in our example. So the company contributes and deducts $600,000 into the ESOP. ESOP takes the cash, goes to the back pocket of the majority shareholder. So he or she now owns only 69%. Went from 75 down to 69%. But we assume that the selling shareholder, the majority shareholder, still is the trustee of the plan to vote the ESOP stock. So even though they have sold 6% economically, from a control standpoint, there's been no change whatsoever. Question, how do we divide the 6% among our 80 eligible employees based on annual compensation? So if my annual compensation is $80,000, and if our total eligible payroll base is 4 million, my 80 grand is 2% of total payroll. So I'd get 2% of 6%. Next year, if another allocation occurs, and let's just say my payroll has gone up to 2.4% of the total payroll in year 2, then if there's another allocation of stock in year 2, I'd get 2.4% of that in year 2. Wouldn't change the fact that I got 2% the very first go around. So the company makes a discretionary contribution. It's up to 25% of payroll. Our payroll of $4 million, so 25% of payroll is $1 million. So the company can contribute and deduct all the way up to 25% of payroll. Now the money comes down to the ESOP, down to the majority shareholder. He or she sells stock, and we say that the corporation's annual deductible contribution to an unleveraged ESOP can range anywhere from 0 to 25% of annual eligible payroll. In this example, $4 million at 25% is $1 million. So the company puts cash in the plan, deductible, cash goes to the back pocket of the selling shareholder. He or she pays long-term capital gain on the sale transaction. The stock is retained, voting is retained by the selling shareholder in this example. And the company has had the ability of flexibility. The company has no obligation to put cash in the plan. So what you do is you wait until the year end, see what type of taxable income the company has, see what type of cash position the company has, and the company can then decide, they've got 75 days in the next year to put cash in the ESOP deducted retroactive to the company for the 12/31 prior. If you take a 6-month extension on taxes, you have until September 15th the following year, eight and a half months after the year end, to see what your cash position is, to see what your taxable income is, and then to put cash in the plan deducted retroactive. So a lot of our clients, in fact half our clients, want to have the ESOP only on an unleveraged basis, where the board has total discretion as to put cash in the plan and can go all the way up to 25% in the good years. Any questions on the unleveraged ESOP? This is kind of the building block of ESOP. And so company gets a current year deduction. The employees don't have to pick up income as tax deferred, like a 401k plan, and the majority shareholder pays long-term capital gain tax rates. Now, how about if you don't want to sell stock this year, but you anticipate wanting to sell some stock? What you could do is you could what we call a pre-funded ESOP. A pre-funded ESOP, the cash basically goes into the ESOP deductible to the corporation. The ESOP takes the cash and buys a CD or a T-bill. Next year, you put in $600,000. That goes into an unleveraged ESOP taxable CD T-bill. So the ESOP is going to invest on a short-term basis in cash assets, CDs or T-bills. So we really have $1.6 million of cash money in the ESOP. Then at the end of the second year, that's when the ESOP buys stock. So the question is, why would you hold the cash during pre-funding as cash asset? A minute ago, the cash hit the ESOP. It went down to the shareholder and it bought stock. But here, we're having the ESOP be buying cash instruments. So what might motivate a company to have a cash ESOP? Maybe you didn't like the share price last year. You're a profitable company, but last year you had a poor year. The appraiser steps in and does the appraisal. The appraiser doesn't know whether last year was a poor year as a one-time event or whether it was really the start of a negative long-term trend. So because the appraiser is unsure about that, the appraiser is going to be probably conservative and give you a share price as a selling shareholder that would be unattractive to you to sell. Okay, but next year you put more cash in the plan. If it turns out you have good years in 16 and 17, then when the appraiser appraises the company at the end of year 2017, they'd look back and say, well, what happened in 14 really was not the start of a negative long-term trend, it was just an aberration. So the appraiser would then be able to give you a higher share price for the stock in, say, the year 2017. Now, the gate swings both ways. The company could stumble twice more. If it did, then you'd be better off having sold stock in the year 15 versus 17. But typically, you've got a pretty good sense for the direction of the stock. So there's a timing play to the selling shareholder. That's the advantage in doing ESOP. It reduces how much has to be borrowed from a bank or from selling shareholders if you put the cash in advance. Okay, this not very friendly looking Uncle Sam. Here you'd like to cash out more quickly at cap gain rates or tax deferred. Because the selling shareholder wants the benefit of full fair market value when they sell stock, but they also want the benefit of either long-term capital gain tax rates as opposed to ordinary income, or a deferral of long-term capital gain tax rates. Here's an example of how it to be a bank-financed ESOP. So Hibernia Bank made 4 successive loans to AFCO Industries, starting in the early 90s, finishing, I think, in the late 90s or early 2000s with the final go-around. So the bank loans to the corporation loans to ESOP. ESOP writes a check to the majority shareholder. So it all happens the same day. Bank loans to corporation, your company reloans the money to the ESOP, same day. Same day, the ESOP writes a check to the majority shareholder. So into that first day, the shareholders got the cash money in their back pocket. ESOP owns 30%. Now we need to pay off the bank loan. This is done with after-tax non-deductible dollars. But what happens is we've got this loan from the corporation to the ESOP trust, and we have an amortization schedule on that interior loan. And as that interior loan is repaid, it creates non-cash deductions. And the non-cash deductions, in effect, make the after-tax payment pre-tax. So ESOP allows corporations like AFCO Industries to use pre-tax dollars to buy back shareholder stock And the deduction comes from the forgiveness of the interior loan. Here's a slide to try and quantify what's the big deal for the selling shareholder. Well, if you have a $10 million company, you're selling 30% for $3 million. If you can sell stock and not have to pay a nickel of tax, the seller's got all the money to reinvest. Here in Louisiana, you've got 20% long-term federal cap gain rates. You've got 6% state cap gain, so it's now 26%. There's an offset against that, so call it 25. And then there's this 3.8% Medicare tax on surtax on net investment income that became effective 1/1/13. So you've got the 28 plus the 3.8 is 28.8%. So ordinarily, you sell $1 of stock, you lose 28.8 cents on the dollar, or 864,000. You've only got 2.1 to reinvest. Here you've got all the money to reinvest as long as you can defer tax on that transaction. So a lot of our clients do the ESOP because they want to sell stock for fair value, not pay a nickel of tax, and they've got all the money to reinvest, not just 75 cents on the dollar or 78 cents on the dollar. Now that's if it's a $10 million company. If you had a company that was worth, say, $50 million, same idea, 30% is $15 million. If you have all the money to reinvest, not just, in this case, 10.7, you've got 40% more capital. So by virtue of deferring what would have been the $4.2 million tax, you've got 40% more capital. Here's a slide that talks about how you can have an ESOP that's done. You could have the ESOP where the ESOP buys stock initially, $3 million in stock. That is 800 grand pre-tax debt service. But you might say that's just too much. I know Uncle Sam's going to pay for roughly 30% of that, but it's still too much money to deal with. So rather than do the leverage transaction to begin with, what you could do is you could pre-fund. So we're going to start off on a pre-funded basis and later sell 30% tax-deferred transaction. So put $1 million in on pre-funded basis, deductible CDT bill, 600 grand deductible CDT bill, $1.6 million. About $1.6 million of investable cash to make the ESOP work. Now you sell the company worth $12 million, that the company's grown in value by 6% per year. So now the company's worth 30% is $3.6 million. So you really have another $600,000 of sale proceeds, 3.6 versus 3. But because $1.6 million has been pre-funded, you really only have to borrow $2 million. So the punchline for pre-funding is it reduces the required bank loan. Not only does it allow you to give some distance if you had a tough year in 14 or 15, give some distance on the valuation, but also this gives you the ability to reduce how much has to be borrowed. So you only have to borrow $2 million versus $3 million earlier. So the required bank loan is reduced by 1/3. Another approach to ESOP is to look at what we call a chip away, where you sell small chunks of stock early on, sell 3%, pay cap gain tax, ESOP owns 30. Now to get to the tax deferral for the selling shareholder, you have to have an ESOP owning 30% or more of the shares outstanding, 30 cumulative. Well, we don't have 30 cumulative yet, we only have 3% cumulative. 4% gets you 7 cap gain also, because we're not at 30%. 5 is 12 cap gain. Now, if you sell 18% to the ESOP in year 4, 18% plus the 12 earlier gets you ESOP 30. So the 18% sale in year 4, because we now have ESOP, the cumulative 30, allows tax deferral to the selling shareholder. Now, to get the tax deferral, you have to meet the mathematical test of 30%, but you also have to be a C corporation at the time of the sale. Well, if you're a C corporation, keep your C election during the time, and then when you mathematically sell enough 18%, that gets you deferral on the 18%. How about if you're an S corporation? There's no reason to become a C corporation early on, so keep your S election. Only moment of truth, when you go to sell 18% more, to defer 18% on capping on 18%, and then if you convert to C Corp to C Corp, S Corp to C Corp, then we can do the tax deferral on that transaction.